Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday night video in terms of the top 5 options plays that we are going to look at for the upcoming week. Now, on the channel, guys, we do use the put wheel strategy, meaning we are looking to write puts at designated strike prices to collect weekly income on those stocks. If ever we get assigned, we are going to very easily write covered calls against the position to generate even more premium. This is a very easy strategy to implement for either beginner, intermediate, or even advanced traders if you want to generate additional weekly income for the portfolio. It's a very, very easy strategy. I've been using it for several years at this point, and it's a strategy that I have used last year to generate over 75% annualized ROI in the trading portfolio that I showcase on the channel in terms of when we do the daily market recap. So if you haven't seen those videos, definitely check them out. We do them Monday through Friday after the close and cover earnings as well. So in today's video, guys, we're going to do a quick recap of our strategy rules. You'll see they're very, very easy rules. Number 2, we are going to recap last week's plays, which turned out very, very well again. And then lastly, we're going to go over the 5 plays for this week. Now, I do also have 2 earnings plays as well, and those will be showcased at the end of the video. So without further ado, guys, let's get right into it. Let's do a quick little recap of our put wheel rules. Very, very easy rules to abide by, right? So number 1 needs to be a solid company, guys. Please, we are not writing any puts on companies we do not want to own. That is rule number 1, because if we ever get assigned a stock of a company that we don't want to own, it just makes managing the position a bit more cumbersome and you won't enjoy the whole process. You much rather get a stock that you don't mind holding even if you're assigned until it becomes available again to write in covered call territory. But for the most part, the plays that I do showcase on the channel are very conservative plays on very good companies. Number 2, we want to be writing on red or flat days, guys. This is just because in terms of the expected move of a given stock in a certain week, let's say the expected move of a stock is 5%. If the stock on Monday or Tuesday already drops 2 or 3%, we can write even lower than the designated strike price that we're already looking for. So it just increases our probabilities of being able to collect that weekly premium and not being assigned. Number 3, we want to look at stocks in a monthly uptrend or long-term range. This once again increases our probabilities that our premium will end up in our pockets at the end of the week and we won't be assigned any shares. Now, it's not bad being assigned shares, but obviously we want to prioritize just collecting that weekly income and being able to rotate in and out of positions very, very easily, and focusing on stocks that are in monthly uptrends or long-term ranges just betters our probabilities even more. Number 4, very big rule, guys, no earnings this week. So whenever I showcase positions, they never are going to have earnings this week. This is because earnings are very, very volatile and very difficult to predict. So even if you might have a very decent level of support, even if the stock might be in a long-term up range or a long-term range, it doesn't mean that earnings can't just surprise you and shoot a big red nasty candle to the downside thereafter, which may leave you in terms of a slight bit of a panic mode. So we want to avoid those and really have very smooth trades on a weekly basis. Number 5, we want to be writing these puts at a support area or a breakout retest area. Support area goes without saying, it's a very large area of support that's acted in the past. You'll see most of the stocks on this list for today and even last week's plays are at big long-term support areas. The breakout retest trade, the biggest example that I can give of this, guys, is going to be on Autodesk. So you see this nice little range that we had right here with the top end of it being 235. We had a nice, beautiful breakout of this range, retest of the top end of the range, and then it ran. So this area right here would be known as the retest. This is the breakout retest zone. That's a very, very strong trade to be taking on a very, very fundamentally sound company as well. Number 6, we want to be targeting 0.5 to 1% in weekly premium, meaning if a stock trades at $100, we want to be targeting either 50 cents or $1 on the bid for the trade. This is just because, guys, in my experience, this is the category of premium here that will be the most profitable and have the highest probability of expiring worthless, meaning that we'll only be able to collect the weekly premium in terms of income, and we will not be assigned the position. Most of these positions, when we're writing around 0.5%, the probability of success goes up to about 85 to 90% most of the time, meaning that most of the trades that you will be writing, the premium will just end up in your pocket. You may get assigned a few here and there, but they should be able to recover fairly well. Now, one of the before last rule here is we want to be writing at or or lower than the expected move. So the expected move is a designated term by Wall Street, and it gives you the expected move in terms of price movement to the upside or to the downside of a given stock in any given week. If you don't know what the expected move of a stock is, you can go on this very nice free website here called Options AI and use their expected move calculator, and it'll give you the expected move for this week and the next 4 weeks, but we want to be focusing on this week. You'll see right here I have PayPal pulled up, and it says the expected move with earnings is about 7% to the upside or the downside. So we want to target this downside area and be writing lower than that. It just once again increases our odds that our position will end up worthless, meaning we just collect all of the premium. Now, the last rule here is we want to set a take profit rule at 90% of the contract value. This strategy is very easy and very hands-free. On a Monday or Tuesday, you can literally spend 15-20 minutes on Monday or Tuesday looking at these plays and then set them and forget them and let theta decay do the rest over the course of the week. But in case you're not at your computer Wednesday, Thursday, and Friday, that is why you want to set a take profit at 90% of the contract. It's the best way to ensure that you secure those profits if ever the contract goes very, very low. You want to be in a position to take profit on those without being at your computer monitoring the charts all day. So that's pretty much everything that I had for you guys in terms of our rules. Very, very easy strategy. And like I said, if you haven't seen my video, you could have clicked it earlier on the video in the top right, but I'll also leave the video in the description down below for a full breakdown on the strategy and exactly how I run it. So let's go through the plays of last week, shall we? So last week's plays, we first had CELH. Now, CELH was a good one. It's been on the strategy here for a couple weeks running. That's because the $50 to all the way to $48 range represents a very, very juicy area of long-term support. You can see on the weekly chart, it's been acting as support now for a better part of the last 4 to 5 months. So that's why I really love CLH. CLH is a beverage company. They have a distribution deal with Pepsi. They sell healthier energy drinks, and they've really been doing a great job at getting some very viral marketing going for the company, which has led to their revenue being extremely explosive, and they're generating revenue expansion at over 20% per year. Very decent margins, very low employee count, so their costs are low, their revenue is high, their margins are good, and they have very good marketing exposure. So that's why we liked CLH. And CLH, I actually took this play myself. So we were looking for the 48 puts around 24-25 cents, and we were able to get them in my own account. So you can see here, we wrote the 48 puts on Monday for 25 cents, which represents our 0.5% rule, guys. If you don't know how to do 0.5%, very, very easy. It's just half of the strike in terms of cent increments. So 0.5% of 48 is just going to be 25. If you want to do the math on the calculator, very, very easy. You'll see that if you just divide 0.25 by your $48 strike, it gives you about 0.5% on the week. So we were able to write those for 25 cents early on in the week and close them when they were almost worthless here for 3 cents. So capturing almost about 90% profit there. So very, very decent trade. Very happy with how CLH played out. And I even have some screenshots here for you. This is the progression of the options premium over the week. You can see on the 29th here on the Monday, this was over and above 30 cents for a large part of the day, but you could have 25 cents available for a majority of that day as well before the premium just started dropping off over the course of the week. So very beautiful trade on CELH. Now, trade number 2 was Caesars Entertainment. So obviously one of the leading casino and entertainment providers in Las Vegas. And if you guys haven't seen the headline, Las Vegas has been absolutely booming as people continue to spend on entertainment. Now, Caesars, where were we looking for, guys? Caesars, we were looking for the $42 or $41 strike. Now, it didn't get all the way down as low as 41, but the 42s were available. And you can see here, guys, this beautiful area of support. We're talking pretty much $42 all the way down to about $38, the lower end of the range. But we were looking for pretty much the $41 or $42 puts. Very beautiful range. The company's been in this range for a very long time. Decently sized company as well. They do have fairly good revenue expansion. Their profits were a bit hit during the pandemic, but have been recovering beautifully over the last couple of quarters, and the guidance for the company is good in terms of that as well. They don't have earnings this week, only earnings next week. So Caesars, We were looking at them at the $42 strike, and they briefly became available. So here's your $42 strike here. I'm sorry if you can't see if it's a bit pale here, guys. My bad for that. I'll do a better job of that in terms of the next week. But you'll see here Monday on the 29th, we were able to get just over 20 cents. The 0.5% rule was roughly 21 cents from the 42s, right? And you can see that the 20 cents were available for a while. They traded about 19 there, but I would have taken that as well. So Caesars was a play you could have gotten pretty much on Monday morning if you were looking for it, and Caesars did end above 42, so that play ended worthless as well. Very, very nice reaction by our support zone here. So I'm very happy with this trade. Did not take that one personally, but it was a very good trade nonetheless. You would have ended up with all of the premium in your pocket. Now, trade number 3 was Philip Morris. So Philip Morris, once again, a stock that was at a long-term support area down here. You can see this about $90 range is where the support zone starts. Very juicy area of support that's been in place since pretty much the past 2 years and a couple months at this point. And they were all, every time that we tend to dip into this area, the stock tends to have a nice reaction back to the upside as bulls do buy the dip. So in last week's video, guys, we were looking for Philip Morris around the $90 range. And unfortunately, guys, you can see this very, very tight range over the course of this past week. It only got as low as about $91, which didn't really free up the $90 strike, unfortunately. So this is a trade that we missed by just a few pennies, pretty much. If the stock would have maintained a lower progression over the course of the week down into the $90 range, we may have been able to pick up the 89s. But unfortunately, Philip Morris, we were not able to take it last week. This is a play that was featured 2 weeks ago that we could have taken 2 weeks ago, but last week when we tried it, unfortunately, we're just not able to get the premium on those trades. You'll see that right here. I have it right here. In terms of the 29th on the open, we were looking for about 45 cents, and unfortunately, it only got as high as about 40, but relatively trading between 30 and 35 cents before dipping off further on in the week. So Philip Morris, unfortunately, was a no-go, but the trade idea was very good. This is exactly what you want to be looking out for in terms of your chart structure here. The play number 4 was Charles Schwab. So Charles Schwab was a company that is a company that I'm very bullish on. It's one of my favorite finance plays in terms of the US because they have extremely high margins because they're the #1 broker by volume in terms of stock trading. So now that they've merged with TD Ameritrade, their margins are very, very good for a commercial bank here. You can see ever increasing revenue, very, very, very decent net margins, and they've been performing very, very well in the past. So Charles Schwab had bottomed out previously earlier in the year around the $50 mark. Now I am really liking them for the breakout and retest trade of this whole zone. So we were really looking at the lower $60 range, and I was saying as close as possible as we can get to $60 is exactly where I want to be. You can see that this area has been acting as very decent support in the past, That's why we want to try for the breakout retest of this area, onto a new weekly uptrend for the stock. So Charles Schwab, unfortunately, this again was one that we were not able to get at our designated strike price of about $60. So let me pull out the premium chart and you'll see exactly why that was the case. We were looking for the 61s, and you'll see here that on the 29th, we were looking for about 30 cents on the bid. Unfortunately, they never got that high as about 30 cents. They kind of started off at about 15 cents for the week, then kind of tapered off before we had a very big reaction here into the end of the week. But obviously, we didn't want to be looking at them on the Thursday. We wanted to have them in the account as of the Monday. So unfortunately, Charles Schwab was not a go for last week either, but it is on the list for this week as well. So we'll show you those premiums in a little bit when we get to this week's plays, but I still love this stock in this area. Pays a very decent dividend as well. Very, very safe play in my opinion. Now, play number 5, was Tesla. So Tesla, we were looking for this one just because of very, very oversold conditions. So you can see how oversold we were leading into the beginning of next week. And that was the whole premise of this trade, right? So we were into very oversold conditions. It was the bottom end of this downtrending channel, and obviously very big horizontal support area coming in between 180 and about 167. So we were looking as far as down as possible. The expected move for last Friday on Tesla was about $175. And I was saying if we could get anywhere under $175, 172, 170 strike, that may be a very decent play for a little short-term bounce relief for the stock. And that's exactly what happened, guys. We never really traded below 180. And here is the amount of premium that we were able to get on the week. So Tesla, I actually took this one in my own account as of last week as well. As I showcased on the channel, we got about 85 cents for these. But Tesla, you can see here that on the 29th, the 170s, I took them on the Friday prior. So on the Monday, they weren't really available. 170, half of 170 is about 85 cents you were looking for on the bid. And you can see that when they opened on Monday, they were only trading about 60 cents. But there was a strike that was available that was below the expected move of 175, and that was the 172.50, just $2.50 more. And you can see here, guys, if you would have went for this one, you would have been able to generate anywhere between 80 cents and pretty much 90 cents on the Monday before the trade pretty much evaporated all of the premium. So you would have been able to pocket all of that premium had you have taken either one of those plays, either the 170s at a lower annualized ROI or potentially the 172.50s for the true 0.5%. So Tesla was a very, very good trade for last week. We didn't get so much of a relief bounce, but it stopped pretty much flushing through the floor, which is exactly what we wanted to do. Anyways, we knew we were coming up on a very big area of confluence in terms of support. So that's pretty much everything for last week's plays. I took a couple of them, notably in the names of Tesla and CELH, but all 5 plays could have been good. Unfortunately, 2 of them didn't really hit. Charles Schwab or Philip Morris didn't hit, but Caesars, Tesla, and CLH were a go, and they did hit our annualized ROI targets. Now, there was a few plays as well that we were looking for after earnings in the name of Google, most notably. 2 of them did not hit, so we were looking for a couple plays. I'll go over the ones that did not hit. So Starbucks, we were looking for Starbucks in the 85 area after earnings. They came out with earnings pretty much on the Wednesday, and you can see, guys, that they didn't really drop that much after earnings. So the 85 puts would have been a no-go. The stock just didn't move low enough for us to get some Starbucks. The second play was Amazon. Amazon, we were really looking for after earnings. If they could have potentially dipped all the way down into this 148 to about 140 range, anywhere in there would have been a decent play to play. Amazon had earnings on Thursday, and we were looking pretty much to write 0.5% in this range. Had they came down after earnings, we were going to be looking for those for this upcoming Friday, so giving us a total week, right? If you write them last Friday on the open after their earnings from Thursday night, we would have been looking for this Friday to encompass 1 full week, right? But unfortunately for us, the stock just moved higher, so we were not really able to write after earnings in this location. The play that did work out, though, for an after earnings play was Google. So Google came down heavily after their earnings, and we were really looking for anything in the 141 all the way down to 138 range, this massive area of beautiful previous resistance, which is now support, which the bulls did react from heavily here on Friday when the stock dipped into those areas. So Google, they had earnings earlier on in the week on the Tuesday, which means that on Wednesday morning, we had a nice opportunity to go shopping for some Google in these lower areas. And here's the charts for Google. So you'll see that the 140s became available after their earnings pretty much. Their earnings date was, to be exact, the Wednesday the 31st on the open, right? So if you would have looked here, you could have found the Google 140s on the 31st in the afternoon for pretty much all the way as high as 80 cents. 0.5% would have been 70 cents before they just tapered off back into the rest of the week. The 141s were available as well. So the 141s, as I said, guys, the area was pretty much your 141 down to about 138. Very juicy spot for buying Google in my opportunity. Overreaction to earnings, in my opinion, by the markets. And you can see here that after their earnings here, the 141s were always trading about 85 cents. Right? You could have got 85 cents or slightly higher during the whole course of the day after that they released earnings. So this would have been a very, very decent trade. We were looking for 70 cents minimum on the bid. So you could have gone shopping here for over 70 cents for a decent amount. So those are all the plays that we had for last week. Some didn't hit, but most did hit, so we're very happy with those. Now, we're going to move on to this week's plays here, guys. So this week's plays, once again, we will be targeting Caesars Entertainment. Why? Because it's still in our range, guys. Don't be surprised if some of these stocks are featured on a recurring basis in terms of on a week-to-week basis. That's just because we are looking for stocks in the support zone. As long as they stay in our support zone without really breaking down under, that represents a very juicy trade opportunity still. That's why CLH has been on there a bunch of times, and that's why Caesar now is recurring as well. So Caesars this week, the expected move is about 41.61 to the downside. From Friday's close, that represents a downside of about 4.21%. So we will be looking for Caesars Entertainment anywhere below the expected move, talking about the 41 or maybe even $40 strikes. Now, if we do move down here on Monday, let's say Monday we move down, open into the 42s, we're going to be looking for potentially the $41 put. So let's take a look at these premiums together, and you guys will see exactly what I want to see in terms of premium. So let's take a look at how the contracts are doing. And you will see that the $41 are trading at roughly our 0.5% rule, right? 0.5% is about, 20.5 cents from 41. And these are trading exactly where we want them to be. So if tomorrow they open like this or a bit higher, if I can even find 0.5%, 20 cents on the 40.5s, I may be going for that. It's lower than the expected move. And if we target the 41s or the 41.5s, let's say, that really gives us a cushion of about 5-6% to the downside. And we're really getting in the lower end of this range. That's why I really like this play a lot. So that's pretty much it for play number 1. Play number 2 is going to be Tesla again, just because Tesla, as I was showing you before, Tesla is continuously still in the lower end of its range down here, still stuck in the, mid 180 range, but we're really going to be looking for anything below 180 at this point, just to stay on the safe side, guys. We want to be getting as low as possible into the 180 to 170 range roughly, while still respecting our premium for the our premium rules for the given week. So let's take a look at Tesla. The expected move down here on the week is about it's about 180. I didn't write it on the chart, guys, but sorry, it's about 180.2, 180.3. So that represents a downside of roughly about 3.5%, right? So we want to be writing below the expected move. So let's take a look at our premiums right now. And you guys can see that the 177.50s at this point are representing about 0.5%, right? So that's going to be your 0.5% rule on Tesla. If I can find 0.5% on 175, I will do the 175s. That would require Tesla to open red on Monday or Tuesday, potentially dipping lower into the lower $180 range, and then I will be more comfortable playing the 177.50s or even the 175s. But I do want to play Tesla in this range as low as possible, guys, right? If Tesla for some reason opens -4% tomorrow, then we're not going to be looking at the 177.50s, right? If Tesla opens tomorrow -4% on the open, let's say, that puts us at 180. It's not enough cushion. At that point, guys, I'll be looking a bit lower, maybe the 172.5s, even the 170s if I can find 0.5%. But Tesla representing a very decent opportunity down here. The stock is still oversold on your daily time frame. Now, stock number 3 we're going to be looking at is Google. So this is a play that came up in last week's post earnings, but is still representing a very decent price right now for Google. So as a quick recap here, previous resistance is now support, 141 down to about 138. I really love Google. It's one of my favorite tech plays for the upcoming year or two. And the expected move for the week is down to about 140.5. So that represents a downside expectation of about 2.1%. So we want to be going 140.5 or a bit lower. So let's take a look at your Google options and see if we can get some premium down there as of right now, the current price. If Google obviously opens red tomorrow morning, that's going to better our premium here on the options chain. So let's take a look, 141 down to 138. You can see that we're getting about 0.5% here at the 141s, right? Half of 141 is about 70 cents. So that does represent our 0.5% rule. But if Google drops tomorrow down into the 142s, maybe even 141, let's say Google has a bad morning tomorrow morning, opens down 1% into the 141 handle, it may open up the 140s or the 139. So I'm really going to be looking here as low as I can get towards 138 to respect our 0.5% rule. Very juicy area of support for Google indeed. So 141 down to 138 is going to be the area that I'm targeting. Stock number 4 is going to be CELH. This should be no surprise. It's been featured on the channel now for the top 5 options plays of the week for about 3 weeks in a row at this point. That's just because it still maintains this beautiful support area of roughly $50 all the way down to $48. So we want to get as close as possible to $48, just as I got last week. So CLH currently closed on Friday at $53.35. Expected move for the week to the downside is about $51. Now that represents cushion of about 4.3% to the downside before running into the risk of being assigned. So let's take a look here. Can we get the 48s to the $50 strike on CLH? We're going to take a look at our options premium. If CLH opens red tomorrow, that will obviously increase our probability of being able to get lower and lower and lower, all the way as close as possible to $48 as we can. Now, if you take a look here at the options premium for Celsius Holdings, you'll see that unfortunately now there is only about 0.5% at the $50 strike. So I want to get a little bit greedy and go below 50. So if for ever which reason we open red tomorrow on CLH, dipping a little bit, I will be looking to write some CLH puts between 50 and roughly $48 as low as I can get while still respecting our 0.5% rule. Now, the $50 strike is still below our expected move by roughly $1. So even if you were right, if the stock opens flat tomorrow morning and you write the 50s, that does give you a cushion of about 6% for the week, which is a fairly decent cushion and is in our support zone as well. I just want to be a bit greedy and get as low as possible on CELH. And now lastly, our last play, guys, is going to be once again Charles Schwab. So Charles Schwab, as long as it maintains this lower range in the $60 area, I do want to write some puts on the company for the previous reasons explained when we did the recap from last week. So the expected move on the week for Charles Schwab is $61.48 to the downside. That represents a cushion of about 2.4%. So if we can get below the expected move, $61 all the way down to $60, that would be a very juicy area for me indeed. Now, taking a look at the Charles Schwab option chain here in terms of how we might open up tomorrow morning. So you can see here, guys, that the $61 puts, which is below our expected move of $61.48, do offer right now about 0.5%. So I would be interested in trading these myself. But if for any which reason Charles Schwab opens red tomorrow in the lower 62, it may even open up the $60 strike for 0.5%. So as low as possible, guys, is what I want while still being below the expected move and while still respecting our 0.5% move. So that's another very decent play on a very solid company for the upcoming week. So those are all the 5 plays that I will be looking at. To make in my portfolio for the week at massive support areas, very solid companies, and very decent premium as well. Now, I do have 2 earnings plays that I will be looking at after earnings, not before earnings. Very crucial. We're going to be looking at these after earnings. That is very important, so it respects our rules. The first play is going to be Fortinet. So I want to show you guys that Fortinet has earnings here on Tuesday, which means that when they report Tuesday after the close, we'll be able to potentially write these Wednesday for the Friday close. Now let's take a look at Fortinet. Fortinet right here is currently trading at $66.48. We want to be targeting, guys, as close as possible to $60. Now this is once again going to be a very, very juicy area of support. If I can label it here on the chart, $60 all the way down to about $47 has been an extremely juicy area of support. You see it best when I break it down on the daily here. So we want to try to get as close as possible as this, but we have to be careful, guys, because Fortinet, for the last couple of earnings, you can see this earnings drop, right? 25% after earnings. And this one as well, from top to bottom after earnings, was down an additional 20-something%. Now, they have priced in most of the negativity from the stock in the last 2 earnings calls in terms of revising guidance down to the downside, but this is why we don't play these things before earnings. So let's say Fortinet after earnings, let's say it has another 20% drop, right, bringing us down in the $50 range. Well, obviously that play is going to be pretty much taken off the table at that point, where we're going to be targeting the lower end of the support area, which is going to be roughly around $50. You can see this very beautiful area of $50. So it's all relative to what happens on earnings, right? If earnings comes down a little bit and after earnings we end up around $60, then we're going to be writing $59 strikes. If it goes all the way down into the lower 50s, then we want to be writing as close as possible to $50 range. Now, the expected move on Fortinet, I apologize, I didn't have it pulled up, but I'm going to show you how this website works while we're here. So you just type in the symbol name, right, and gives you the expected move for the week. So you can see the expected move to the downside is about 8% to the downside, $61 to the low end. So that's why we're going to be looking for this range. If ever it does drop into $61 after earnings on Wednesday morning, I will be looking anywhere below $58, $59 for Fortinet, one of my favorite cybersecurity plays in the entire market currently. And you can see it's just been in this massive range of accumulation here ever since 2022. And our last earnings play, guys, is going to be NXPI, semiconductor play. They have about 4% of total market share in terms of semiconductor manufacturing, the market leaders being Qualcomm, Intel, NVIDIA, and AMD. But NXPI is a very solidly run company, guys, extremely solid company, as a matter of fact. They do pay a dividend, price to earnings ratio is not that high, and they do have increasing revenue, increasing profit margins, and very good forecasts over the next foreseeable future, right? Increasing EPS for the next couple of years, and decent revenue, streamlined revenue as well. So really expecting this stock to at most just hold. We are just looking for, once again here, guys, the continuation of our weekly uptrend potentially, or maybe even just a tightening range. The area that we're looking for here, guys, is going to be anything below $200. So the expected move on NXPI is down to about 204.76 after earnings. This company has earnings pretty much Monday after the close, so it will be available starting Tuesday morning. Now, if the company drops below the expected move, let's say we drop below the expected move, about 5% down to the lower $200 range, I'm going to be targeting this area right here, guys. Okay, this whole area right here, 200 down to about $195 is the zone that I want to be targeting. It's been an area that's played as resistance in the past, support for a bunch of times here, so we're going to be looking for it to play support once again. If I can find some options down here for about 0.5% will be about, 90 cents to roughly $1. If I can find that on Tuesday after a dip, going as low as about 195, I'm definitely very interested in playing NXPI for that very, very, very juicy area here that it's been breaking out of and now simply just retesting. So those are all the plays that I had for you guys for this week. I hope you guys enjoyed the video, and be sure as well to check out our daily market recaps that we do Monday through Friday. We do the technical analysis of all your major indexes, your major tech names. We usually do about 2 or 3 earnings reviews per day, where I go through the company's financials that they just reported and determine whether or not the company is a good investment. And we obviously cover my portfolio as well, where I show you all of my personal trades that I've been making in the markets. So hope you guys enjoyed the video. If you did, consider dropping a like. I'd really appreciate it for the YouTube algorithm. And as usual, guys, if you're new to the channel, please consider subscribing for either these videos that we do on Sunday. We also do educational videos, and we also do those daily market recaps. So a lot of fun stuff on the channel. And as usual, guys, if you have any questions whatsoever on any of the plays that I presented in the strategy for this week, or any questions on the strategy as a whole, or anything really, please feel free to leave them down below in the comments. I usually always respond within the first 24 hours. So take care, guys. I'll see you tomorrow for our daily market recap after the close. Peace.